Good afternoon, everyone. Thank you so much for being here. My name is Kelly Beard, Content Specialist for Maryland Realtors, and I want to welcome you to the Tax Masters and Maryland Saves webinar. Today, we have with us our Director of Advocacy and Public Policy, Lisa May, Chris Cullen, Marketing Director of Maryland Saves, and Preston Hall, EA, and Linda DeMarlo with Tax Masters, Inc. Lisa will be leading you in the discussion of financial planning, tax tips, and programs that Maryland has to offer. As a reminder, this webinar will be recorded and will be sent out to all attendees after the conclusion of the webinar. We will also post it on our YouTube page if you'd like to share it with anyone else. We encourage your questions and we look forward to answering them. Please post all questions in the Q&A box below at the bottom of your Zoom screen. We will be answering them as we go and at the end. And with that, I will turn it over to Lisa May. Take it away.
Kelly, thank you so much. And thank you to the Realtors out there who are joining us today for our tax tips and financial planning webinar. Now, you may think that this is a really odd time of the year to be talking about this, but there actually is a reason why we chose October, and that's because it is financial planning month. And I'm sure that October was chosen because now is the perfect time to make adjustments to your budgets, to your finances, to really make an impact the next time that those tax deadlines roll around. First, we want to talk to you about the Maryland Saves program. And why we want to do that is to make sure that you are on track to meet your retirement goals. That is one of the pillars of a good financial plan. And quite frankly, most Americans are not on track to meet their financial goals and are not saving at the rates that they should. And independent contractors like you are facing especially difficulties in saving. One measure had independent contractors saving for retirement at a rate that was 6 times less than the typical American. So we want to get you saving for that wonderful retirement day when it comes. And that's why we invited Chris Cullen here to talk about the relatively new Maryland Saves program. So Chris, why don't you tell us what Maryland Saves is all about?
Sure, it's a state-sponsored program. So relatively new means it was passed into law in 2016, and it took the state and its friends a couple of years to get it out into the marketplace, but it's alive and well and popular amongst some folks. I'm going to share some screen and walk you through some slides. So I'll just preface this with telling you that I'm the marketing guy. So if you have really tough questions and you pop them in the chat line, I'll take them back to the money people and they'll answer them. I have a general idea, though. I can answer most of them. But as the marketing guy, I can tell you this is our elevator statement. It's a state-sponsored retirement savings program for small businesses and the people that make them great. So as Lisa was telling you, there is a national retirement crisis. And if you Google anything like that, you'll find the numbers are pretty stunning. The number of Americans age 65 and over is set to increase to 73 million by 2030. And there's a $7 trillion retirement crisis. And it's going to get worse. And the burden on states and individuals and federally is going to be almost impossible to bear. So there's 1 million Maryland workers who have no access to retirement savings plans at work. And the number one source of employee financial stress is the absence of a plan for financial security. And this is a really powerful stat. It's an AARP stat. It says that people are 20 times more likely to save for retirement if their savings plan is automatic, if it's automatically deducted from their payroll. So in 2016, Maryland passed a law that said employers that pay employees through a payroll system or service provide access to a payroll deposit retirement arrangement. So this is a requirement. It's mandatory. However, there is no penalty. The only penalty is if you don't take advantage of the incentive, right? So Maryland Saves was created with the law to make it free and easy for employers to comply. and it applies to all registered Maryland businesses in operation for at least 2 years with one or more W-2 employees. So this kind of law is going to pass in about 42 states over the next 2 or 3 years. It's in 7 states now, but Maryland is the only state where it is incentive driven. There is no financial penalty for noncompliance. As I said, instead, as an incentive, Maryland Saves offers a $300 SSTAT annual report filing fee waiver. That $300 you pay every year when you register your business with the State Department of Assessment and Taxation. So to get the filing fee waiver, one, you have to be registered in good standing with SSTAT, and have at least one W-2 employee enrolled in the Maryland Saves program, or B, participate in another qualified program. Because the goal here is not to make Maryland Saves the most popular retirement savings program, but to make retirement savings available and popular. So wherever it is, we're just trying to promote retirement savings. Maryland Saves is an option. So if your organization participates in Maryland Saves, then Maryland Saves will take care of getting the name of your company to the State Department of Assessments and Taxation, and you'll get your fee waived. And for every year that you participate in Maryland Saves, that fee is waived. So every year you will save the $300 when you offer a retirement savings plan. If you offer another qualified plan, you can claim your exemption at marylandsaves.com. And I know Kelly and Lisa probably mentioned you will get a copy of these slides, so all of the emails or my email and the website are all in here, so you don't have to jot all this junk down. All right, what this means for employers: one, it's free and it's easy. It takes about 15 minutes to register your company, and then when you do that, it's essentially the last thing you have to do. There's no fiduciary or legal responsibilities to the organization. You don't have a role in telling or promoting your employees about the program. That all comes from our organization. As soon as we get your employee list, our organization sends communications to them. And at the end of the day, it's a tool for recruitment and retention. So what facilitators, what the employer does is just facilitate the program. Most eligible employers will automatically receive via the mail and email an activation code. If you didn't receive an activation code or an access code, you can request one at marylandsaves.com. There's a button that says request access code. You'll just need your SSTAT number. Maryland Saves will work with the payroll processes you have and can be managed by payroll providers. We have payroll integration agreements already with several groups and several more on the way as we're rolling out as the program matures. So the employer's role is simply to register. You set up, upload payroll and your employee census into the system. You keep your staff list up to date, and you submit the employees' contributions. We'll talk about that in a second. So when you register, these are the things that you need to have with you. I don't need to read these, and you'll get this PowerPoint, so you can take a look at this when you choose to register or want to consider it. You bring all your company information, your banking information, you log on and put your employee census in there. Then you use their SSNs or ITINs and their dollar amount for their contribution when you run payroll. So for employees, one, they must be at least 18 years old. Two, they have to be employed in Maryland. And three, they'll be automatically enrolled. So it's an opt-out. So most individuals who earn more than $144,000 per year aren't legally allowed to contribute to a Roth IRA, which is what Maryland Saves is. You'll have to see, maybe Preston and his team have more information on that, but for more information, you have to see the IRS publications. So for employees, if the employee chooses not to opt out, automatically 5% of their earnings will be deposited into a Roth IRA. Employees have complete control over their accounts. They can change their contribution rate at any time. They can opt out at any time. They can zero it out. The Maryland Saves program is unique. among the states that do this. We have an emergency savings feature, which means the first $1,000 that the employee has put away into the account is available to that employee in the case of unexpected expenses, flat tires, medical, pets, whatever happens, and it always will happen. And Roth IRAs belong to the employee, so if the employee chooses to travel or go or take another assignment, it will travel with them. So that's a lightning tour of the Maryland Saves program. I don't know, Lisa, if you picked up any questions.
I don't see any as of yet, but we will give folks just a minute or two to maybe type some in that came up. One thing among our members, there are probably some that have organized their business as an S corp and pay themselves through payroll, but we probably have quite a few others that are just organized as, say, an LLC. So is there any difference in the procedure that takes place if, say, for instance, you're an LLC and you're not running payroll specifically?
Well, if you run, I'll start this way. If you do run payroll, say you consider yourself an employee and you pay yourself through a payroll system, that payroll can be imported through the Maryland Saves platform, and you'll be considered a participant. If you don't run payroll, but you do participate yourself in a 401k or something, you can claim an exemption. So you don't have to be a part of the Maryland Saves program to get your $300 waiver if you are saving someplace else. And as any individual, you can choose to become hold a Maryland Saves retirement savings account, simply just a Roth IRA.
I also have a question, Chris. I know last year we took advantage of this because we have a 401k. And I think last year we had to fill out a survey by a certain date to make sure that we got our $300 waiver. Is that going to be an annual thing, or are you, once you do it once, it kind of carries over each year? Do you know?
You have to certify your exemption, or Maryland. If you're in Maryland Saves, we submit your name to SDAT every year. If you are participating in another program, you have to certify your exemption every year to get the $300 waiver.
Perfect. Do you know what the deadline is on that by any chance?
It's December 1.
December 1. Yeah, because I remembered it being, it wasn't an April 15th type of thing. It was.
Yeah, it's December 1 because the idea is that within 30 days, then the payroll gets uploaded. So you get uploaded payroll inside the calendar year.
Mm-hmm. It was nice not paying $300 this year.
Yeah, it seems to be the most compelling value proposition that we have from business owners. But I think, as Linda was saying earlier, there are a lot of particularly new and small business owners who really want to take care of their handful of employees and to give them any kind of benefit they can to keep them on board.
Oh, yeah.
See, I love it when panelists have questions for each other. This is great. Chris, you mentioned an IRA. The Roth IRA is the savings vehicle for Maryland Saves. What type of investment options are you offering? Do you go through a Fidelity, a T. Rowe Price, or something like that? Can you talk a little bit about those options?
Yeah, BNY Mellon, which is formerly Bank of New York, and Mellon. BNY Mellon is the custodial bank. That's where the funds are managed, and the investment advisors are T. Rowe Price, BlackRock, Fidelity, Lincoln Financial, and employees can have control over where those funds, to a large degree, are invested.
Wonderful. All names that you've heard of, guys. I mean, very, very big, reputable companies that Maryland Saves is using for you to direct your investments. Still not seeing questions in the Q&A quite yet, but Chris will hang around here with us for a little bit. And if something comes to mind and you want to type it in, please go ahead and we'll be sure to get you the answers for that. But Chris, thank you so much. Love letting people hear about Maryland Saves, since I myself only recently learned of it. And we're happy to spread the word. on such a great program. So thank you.
Sure. And my email is in the PowerPoint. Should you come up with a question, or when you talk with someone who's about the program and maybe they have a question, you can always send it to me.
Wonderful. Thank you. Well, we've saved you $300 already in just 15 minutes. Now let's see what else we can get for you. When we hand it over to Linda DeMarler and Preston Hall from Tax Masters Inc. They are here to get real estate agents all of the tax advantages to which they are entitled. Oh, Linda brought money. Wonderful. Excellent. So I'll hand it over to you guys. Let's get to work for our members here.
Fantastic, fantastic. And just before I share my screen here, I just want to let you folks know, Linda and I both got our start in real estate. We specialize in realtors. We've gotten rid of a lot of our non-realtor, non-real estate professionals clients over the last few years so that we can specialize in realtors. We love teaching you folks. We don't need clients. We're always happy to take on realtors as clients. We don't need them. We've been in business for over 50 years. This is an article from the Washington Post with a picture of my mother from the 70s. We've been around for a while, and we love, I just spoke with you guys. I actually, it's kind of a coincidence. Well, they just fell on the floor, but those are my credentials from speaking for you folks just at All In just a few weeks ago. So I thank you for having us back. We love working with you guys. So let's get my screen share up here and get started. All right. Here we go. And so we like to start off with a little quote from Albert Einstein that the hardest thing in the world to understand is the income tax. And this is something that he had told his tax preparer, because when he emigrated to the United States, he could not figure out how to file his tax return. Back then, they would send you a copy of a tax return in the mail, a blank one, and then you were supposed to figure it out, handwrite it if you didn't have a tax professional, and send it back in. He spent weeks trying to do it, couldn't figure it out. And so, this came from a conversation he had with his tax preparer. And we all know Albert Einstein was a genius. He's smarter than any one of us. However, he was not a specialist in taxation. And you folks are all specialists in real estate. You are not tax professionals. So what we want you to always remember is never, ever, ever, ever give tax advice to your clients. We don't want you getting sued. We don't want you getting somebody out there, causing you, getting you a bad reputation because you gave them improper tax advice. You need to be working with a tax professional who, whether or not you use them to do your taxes, you need to have somebody that you can send your clients to who can answer their questions as it pertains to real estate transactions, so that the person understands that, and usually a good accountant can, explain to them why this real estate transaction may be beneficial for them, whether it's for building equity or saving some money. But typically, you want a tax professional doing this work for you. We do it as a consultation because we need to look at the entire situation. We can't just simply answer a question over the phone. You know why? Because the answer to every tax question is, it depends. It depends. Without looking at a client's entire tax situation and understanding their goals for their present goals as well as their future goals, we really can't give good tax advice. So we need to look at everything before we can answer a question for a client. So we definitely don't want you folks out there answering questions for your clients. I'm going to go really fast today. This is about 90 minutes worth of material, and I'm compressing it into 45 minutes here. But I want you all to get the gist. If you have some questions, don't email me for the next 4 days, because those of us who are late bloomers know that that the tax deadline is coming up in a few days here. But in all seriousness, I'm happy to talk about some of this stuff, and we're happy to answer some questions today as well. All right. So we've got some recent changes. There's a lot of IRS agents being hired. This is not something I don't want you folks worrying about being audited. Just make sure you're doing a good job. You have a good professional preparing your taxes, and you shouldn't have to worry about audits. But you know, they are going to be auditing a lot more people. They really haven't been doing any for about 10 years. 10 years ago, they were doing a lot. We've got the biggest jump in tax brackets in years. So you folks are going to save some money in taxes. If you're making the same amount of money each year for the last couple of years, you're actually going to be paying a little bit less in taxes. So this is one case where inflation is helping you out because the tax brackets are getting higher. It's something we don't need to worry about the additional child tax credit because that's from last year. QBID for real estate investors. Now, as self-employed individuals, you all get to take advantage of qualified business income deduction. Now, if you are a real estate investor, this is new as of a couple of years ago. Congress said, you know what, real estate investors, they're in business as well, and they can take advantage of the qualified business income deduction. This is something where if you're showing profit on your rental properties, you should be talking to your tax advisor about whether or not you're taking the QBID. Most rental properties actually show a loss on paper, but if you own a rental property in cash, then you're probably showing a significant profit. So you do need to know about this. Business meals for the last 2 years, they were at 100%, which was the first time since I believe the 1986 tax cuts. So we had business meals deductible at 100% for the last 2 years. Well, unfortunately for 2023, they're back at 50%. The idea was to get people back into restaurants, and you know, we're from Rockville, and if you know anything about going to restaurants around here, the last thing Congress needed to do was get people back into restaurants because they are slam packed. So I'm sure it's different in other places, but that was probably not where Congress needed to focus its energy the last few years. The 1099-K, if you're getting payments of more than $600 or paying other people more than $600, this is typically for transactions over the internet, Venmo, things like that. You're going to get a 1099-K. You need to make sure you provide that to your tax preparer and let them know what it was for, because oftentimes it's for selling something online or something like that, and rarely do you end up having to pay taxes on this amount. But if it's not on your tax return and treated properly, then you'll get a letter from the IRS saying you owe a good bit more money than you do. So if you get those 1099-Ks, give it to your tax preparer, let them know why you got it, and then they should know how to treat it accordingly. So I'm going to skip that one. Linda, let's go ahead with current tax rates. I'm gonna let you go ahead.
Hi there, everybody. I got after Preston for not having a shirt on, but he's been working since 3 o'clock this morning on all the clients who are finally getting back to us with last minute information. Okay, these are the current tax rates that are in effect for this year. And you'll see they're really good. It doesn't take a lot of income, though, to get into, let's say, the 22% bracket. So if you're single and your taxable income, and by taxable income, what I mean is after deducting the heck out of everything, your business deductions, personal deductions, things like that. After you've finished all of those, if you still have at least $44,000 to pay taxes on and you're single, then every dollar above that $44,000 is going to get taxed at what rate? Come on, look there, 22%. And if you have at least $95,000, oops, I hope so, then you're going to get taxed at 24 and above. Now, if you're married filing a joint return, it just doubles. So a married couple that has at least $89,000 taxable income, and that's pretty easy to do in the DC, Maryland, Virginia area, they're going to be at least in the 22 to 24% tax bracket. So that's only your federal bracket. What's the other tax we all get to pay? Okay, next slide, please, Preston. Thank you. Here's our state rates. As you can see, Maryland is the highest. It's okay. It's a great state to live in. I've been here since I was 9 years old, and of course I love it. But we do have a tax rate that goes up to 8.95%. To be in just the 8% tax bracket, all you have to earn is $3,000 taxable income. So everybody today who's listening to me, you're at least in the 8% bracket. DC's a little lower and Virginia is much lower, but in Virginia has some other taxes, so we won't concentrate on them anyway. However, let's go to the next tax, which I call the insidious tax. It actually has 4 names. You can call it self-employment tax, FICA tax, Social Security tax, and Medicare tax. But I don't care what you call it. I call it the insidious tax because this is the one that you absolutely can't get out of it. There's no deduction that reduces this tax except one kind and one kind only. The only thing that will reduce this tax, which ends up being 15.3% because you are your own boss, the only thing that will reduce it are business deductions. So it doesn't matter how many children you have or how much you give to charity, or God forbid, if you have a lot of medical bills. None of that will change that. The only thing that's going to reduce this is keeping track of all of your business expenses. And we're going to cover a couple of them in a minute, which is your car and, very important, your office and home. So now, did you add all of your tax rates together? Let's look at the next slide. If you're only in the 22% federal bracket, remember, it only takes 44,000 if you're single and it's 80-some thousand if you're married. But if you're in the 22% plus the Social Security, Medicare, FICA, whatever you want to call it, plus the state rate of Maryland at 8%, that's a total of 45%. So that means if you call me up in December and say, oops, I just earned an extra couple commissions and they total $10,000. How much tax do I owe? I would tell you that if you haven't got any other business deductions, you're going to definitely have to pay $4,530 tax on that extra $10,000 that you just earned. So this is why it's important to keep your business deductions. Now, of course, most of you, of course, all of you, I hope, are in the 37% bracket, which means your effective tax rate at the end of the year is 60% of any income for which you don't have what? A business tax deduction. So when we talk about business tax deductions, I bet you're going to pay attention. I get one more slide, Preston. What's the next one? Investment properties. Wow. You know, I have a real estate license. I still have a real estate broker's license. I don't use it. I'm not in competition with any of you folks, but I love real estate, and I've been speaking for the real estate commissions all over the place for the past 40 years. So love people who buy investment properties. Matter of fact, when I did real estate, I only did commercial and industrial. I never knew about kitchens, things like that. But if you have a client who's going to be buying an investment property, you need to be aware of a law that's been in effect since 1986. Now, everybody wants an investment property because they think it's going to throw off lots of good tax shelter. Well, it is, but maybe not immediately. Because if your investor is not a real estate professional, in other words, they're not you, they're not licensed, and they're not going to manage the property themselves. In other words, they have another job 40 hours a week of any kind, then they are not allowed to deduct any losses from that rental property the minute they make $100,000 per year or more total income. So what you never want to do is be like Ralph Rookie Realtor, and this is a case I worked on. He said, doctor, you should buy this townhouse. It's going to give you tax shelter. Well, no, the doctor made well over $100,000 and he didn't get tax shelter. And guess who got sued? Ralph Rookie Realtor. Don't worry, they brought me in as expert witness and I got him out of it. So there are ways to claim the deductions. You just have to wait until either you sell the property or your income drops below $100,000, or better yet, and this gets you a commission, when they sell the property, then they can take all the unused losses. But in the meantime, just be careful. Now I'm going to turn it over to Preston because he gets to cover the next two.
Oh, no, the 25. How did I get the $25 and $75 rule slide? This is your favorite one.
Oh, I'll cover it. Let me cover it. I'll
You want
take
to do it? You okay?
Yes.
Yeah.
Yes. Okay, the $25 rule has been in effect since before I started doing taxes, which is a long time ago in the 70s. Here we go. $25 rule says you can only deduct $25 per year per client per married couple. for gifts. So if you give a client a gift, and you're welcome to give them any gift you want, you may want to give them a $100 gift certificate. They just bought a lovely house in Potomac from you. Give them a $500 gift certificate. Give them anything you want, but you can only deduct $25 of it. But if you have something that is actually your advertising, then you can give them that gift. And if it's got advertising, it's fully deductible. An example, we have a client at every settlement, she walks in the door with one of those green like Tupperware or Rubbermaid trash cans. And on the trash can, it says, looking for a house in Potomac or looking for a house in Aspen Hill, call so-and-so realtor. And it has all of the required information about her brokerage and her broker. And it's got her name and phone number. So we can deduct the cost of everything because it's advertising. And then she can still buy $25 worth of things to put inside, like linens or toys for the children or a plant. So then it's advertising, it's deductible. Now the $75 rule, oh my gosh, this is a wonderful rule that hardly anybody knows about. There is a law that says that you can deduct up to $75 per occasion or per incident for any business expense, and you need not have any receipt. You don't have to charge it. You don't have to have a receipt from anybody. You just have to make note of it. And you can do this on your iPhone or a piece of paper or whatever you want. You just have to write down the date, the amount, and the business reason. For instance, let's say you're going to hold a house open and you know it's been vacant for a while. What's the first thing you take to a vacant property? I remember this. You take toilet paper. So you stop at the grocery store, you pick up some toilet paper and maybe some Windex and maybe something to make the house smell better. And you can deduct all of those items. So what do? You just write down on a piece of paper, because you don't want to have to keep this long receipt. Write down $60 supplies open house. Now you get to the open house, oh my gosh, the yard is a mess. Maybe it snowed, the garage is a disaster. And you get the young man who lives next door to come over and you give him $50 and he cleans up the yard, mows the lawn, shovels the snow or whatever. Okay, now you write down $50 clean up open house. So in one day, you've just spent $60 and $50. Can you deduct them? Yes, because each event was separate. So that's $110. Now, if you're in the 40% tax bracket, which I'm sure every one of you is, then on that 110, you just saved $44 income tax and you didn't have to have a receipt. So this is a very important rule. I have ladies who tell us that they spend $50 a week paying the kid next door to wash their car. Well, that's a good deduction. Guess what? We get back 40% or 44%, whatever, on the rest of the money. Okay. Preston, I think I get the next one. No, I have the next one.
Do you? Okay.
No, you have the next one. Sorry.
Okay. Let's see here. Yeah, great. So two things that people misunderstand about this slide. With the $25 where Linda says we can make it advertising, that doesn't mean going out and having your name printed on a $100 bottle of scotch is advertising, because who's going to see that? Just the client. It's not going to be other people who are potential clients, whereas the trash can is going to be seen by all of the neighbors. So just keep that stuff in mind. You know, if we're talking about $1,000, $2,000, it's fine. We can work with things. If you're going out and spending $20,000 on gifts and going to try and call it advertising, we've got problems unless things have been done properly. Also, another misconception we get with this is Linda said if you have expenses for which you paid cash and don't have a receipt, but you keep a log with this information, you can deduct it. For some reason, this gets misconstrued every time as Linda said, every single open house I have, I can deduct $75 without having a receipt. That's not what we just said. If you spend cash, Ma, has this not been adjusted for inflation since the Cohan case?
No, it started out as $25 for George M. Cohan, and that was back, God, I think in the 30s or 40s, because George M. Cohan, he's the one who wrote Give My Regards to Broadway and all that. So it's only been raised from 25 to 50 to 75. This is terrible. I mean, they certainly haven't kept up with inflation. It should be more like $500.
Right. I agree. Unfortunately, we've gone to a cashless society, so we don't see too
Yeah.
much of this anymore.
Right.
Okay, so I get this one. Fantastic. All right. Deductible expenses of your primary home. When people think about their deductions, a lot of times one of the first things they talk about is going to be their home, and their home is a deduction for them. As realtors, it is a decent deduction for you folks, but it is a very much a second tier deduction because Linda outlined 4 taxes before. And hold on, I'm just changing my screen around a little bit. All right. And Linda outlined 4 taxes before: your state tax, your income tax, your Social Security tax, and your Medicare tax, which make up your self-employment tax. And so most of the stuff we think of with our primary residence does not save us on all 4 of those taxes. It only saves us on our federal tax and our state tax, with certain exceptions that we're going to get into later. And so I don't want you to think of your primary residence as your biggest deduction. It's not going to be, as a realtor, it's going to be a good deduction for you. It's not going to be one of your best deductions. We can write off, as a personal deduction, we can write off the interest paid on the principal up to $750,000 of principal. Anybody who's been in the game for a little while remembers it used to be $1 million. You can have up to 2 houses. Why is that? Because every senator or congressman has to have at least how many? 2 houses, right? One in their district and one in Washington, D.C. That's why it's not 3. That's why it's not 1. But the max that you can write off of that interest is on 750. So if you have 2 houses and your loans on them equal $1 million, well, we're going to take the loan we're going to write off the loan with the highest interest rate first, and then the remainder we will write off. It will write off up to $750,000. Then we've got our real estate taxes. And if you're in this area and you make any sort of money, you're not going to get much of a real estate deduction because you pay enough in state taxes that you're probably going to get phased out, because we have what's called the SALT limits, which is your state and local tax limits. And that we're limited at $10,000 on that. So you don't have to make too much money in Maryland before you start getting limited out on taking the SALT deduction. And so with our real estate taxes, we have a little bit of an exception. Keep in mind, everything I just outlined saves you on your federal income tax and your state income tax. Actually, this all gets backed out, but we could save you on all 4 taxes as a business expense if we have an office in home. Before I just want to get into a tad bit before you take over. I think this is Yuma. But about 10 years ago, when we'd do this speech, we'd ask people, hey, is your accountant telling you office and home is a red flag? About half of people would raise their hand. Now, when I give the speech, 1 or 2 people might raise their hand. The law hasn't been changed, but the IRS made it simpler. It was around 2016, the IRS made it simpler, and they allowed you to do office and home utilizing the simplified method. Linda, do you want to talk about the simplified method, or you want me to talk about that real quick?
No, because the simplified method's not good for anybody. If the IRS suggests that you use it, then what do you think it's good for? It's good for them. That's it.
Yep.
No, let me talk about.
All right, go ahead.
Office and home. I helped get this law changed in 1999. Before that, the Supreme Court said that you couldn't claim an office and home unless you had a separate entrance. You had to see clients there 5 days a week. None of that. That's baloney. So I helped overturn the Supreme Court. Yes, I did. My clients and I who were in Congress. So the new law, which has been in effect since 1999, says anybody who is self-employed, and that means you could have a subchapter S, you can have an LLC, you can have a C corporation. Anybody who's self-employed or employed at home can claim an office and home as long as they use it. Just 2 words. The next line: regular and exclusive. Okay. You don't have to see clients there every day or any day. You don't need to have a separate entrance. You don't need to have a separate room. All you have to have is a space in your home that nobody else uses, and you use it regularly. And as a realtor, I know that you work regularly, and of course you have the space, exclusive space, because you don't let your kids or your hubby or somebody else play in that room. Now, this means that now you're entitled to claim a portion of your home mortgage, a portion of your home real estate taxes, and a portion of all of these expenses, depending on the space that you use. The average realtor uses about 6 to at the most 10% of their home. I do have a realtor. She lives over here in Silver Spring. We use 55% of her house for business, because she has a rambler and the whole lower level is her office, and one smaller bedroom upstairs is where she keeps her signs, so she doesn't have to take them up and down. Okay, so whatever it is, that's we get to claim, and we get to claim that same percentage against the mortgage interest, real estate taxes, insurance, homeowners, PMI, cleaning, trash removal, repairs, utilities, HOA, condo fees. I love this picture here. It looks like Preston with his 2 kitties. But in any case, now a previously personal deduction, which was limited, such as your mortgage interest and your real estate taxes, is now unlimited as part of your office and home. Now, of course, you still have to take the percentage of it that you use for business, but this is a wonderful deduction. And there's even an additional benefit besides claiming office and home. And I think, let's see, who gets the next one? Okay, Preston, or no, I do. Commuting. If you have an office in your home, you don't have commuting. I'll give you an example. Sometimes on Saturdays, I go down to Sirius XM radio and do a show down there on real estate and taxes. And I leave from my house in Bethesda. I drive to Eckington Place Northeast, and then afterwards I drive home. My trip is deductible because I leave from my home office and I come back to my home office. But if I didn't claim an office in my home, first of all, I would lose the deduction, God forbid. But then I would have to drive from my home in Bethesda to the office in Rockville and then to Eckington Place. No, I don't want to do that. So if you claim an office and home, which in itself is a $3,000 or $4,000 deduction, you also get to claim more automobile expenses because you're going to use your car more, since you can use every mile from the time you leave your house to go to the next job. And this saves all 4 taxes. You have no more commuting expenses because commuting isn't deductible. Now I believe it's Preston's turn. Yes.
Yep, that's me. And so one of the back when everybody thought that office and home was a red flag, what people didn't realize is if you had a tax return and there was no office and home, but you had 80 or 90% business use of a vehicle, it would be near impossible to have 80 to 90% business use of a vehicle if your first trip of the day and the last trip of every single day was a commuting expense as opposed to business mileage. So if you don't have an office and home on your tax return, there's no way to justify even 75% business use would be far too aggressive. And so we have seen that situation in an audit where somebody did outside sales and he was driving 40 to 50,000 miles a year. And his previous preparer thought that an office and home was going to be a red flag for him. He got audited. Somehow he found out about us. We handled the audit. At the time, we had somebody who was just handling audits because, like I said, 10 years ago, they were doing quite a few audits. So we handled that audit. We talked to him. We realized he did have an office and home, went back, amended the returns, provided it to the auditor, and audit was over. They realized, hey, yeah, no, this mileage is completely justified due to his job and the fact that he does all of his admin work from home. So
they had to give him a refund because now he was claiming office and home expense. It was a win-win.
Now, I haven't told you to take any notes, but the one thing you do want to write down is 8829. Look at your tax return from last year and make sure there's an 8829 form. And then you know that not only are you taking the office and home, but you're using the proper method as opposed to the simplified method, which saves you the most amount of money. All right. So let's see here. Another question we get is, should I do actual expenses on my vehicle? Because the vehicle expense for a realtor is oftentimes one of the largest line item expenses on their Schedule C. And so we want to make sure that we're taking advantage of that as much as legally possible. And so we'll talk with clients, and we look at both methods for each client, and preferably when they purchase the vehicle or before they purchase the vehicle, but to discuss whether we're going to use the actual or the standard mileage rate for deducting it. And in most cases, the actual mileage rate is going to be more beneficial than the standard mileage rate. The exception typically occurs if you have an older car, probably something Japanese, something reliable that doesn't need a lot of repairs, and you drive quite a few miles every year. In the last couple of years, the standard mileage rate has been higher than typically in the past. Usually it's in the around 50 cents per mile. It's probably going to be closer to 58 or so next year. So it is the cents per mile rate right now is higher than it typically has been. But when we use actual expenses, we get to depreciate the vehicle, and vehicles have become so expensive these days that for realtors, typically actual expenses are going to be the better tax deduction for them. If I see a tax return prepared by another preparer, and I'm not one to badmouth other preparers. Oftentimes I'll look at returns and I'll tell a potential client, like, look, this preparer is both cheaper than us and they're doing a decent enough job. But oftentimes I'll find out a potential client has a vehicle that's not cheap, and then I look and they're taking the standard mileage rate, and their total miles was $10,000 miles last year, and their business miles was 8,000 miles. It's like, well, obviously these are BS numbers, and nobody's actually looking at the entire situation and doing this properly. So you do regardless. In both situations, you have to track your mileage, because when we're using actual expenses, we need to come up with that business percentage so that we know what percentage of the vehicle we can depreciate, what percentage of your gas we can write off, parking, things like that. Well, parking is it's either business parking or not. All right, who's next? Is that you? Yep.
Me, I get to take, okay, remember now we're doing a 90-minute show for you in 45 minutes, so I'm going to go a little quickly. I'm just going to give you the overview. But when you are self-employed, and this works best if you are an LLC being taxed as a single person, or if you're just a sole proprietorship, you are allowed to deduct all of your medical bills as a business expense. Now, normally, can people deduct medical bills? No, because they have to exceed a certain percent of your income. I think it's 7.5%, depending on your age or whatever. But if you're self-employed, they passed a law in 1955. So this is not a new law. It's been around a long time, that says you can deduct your medical bills for your whole family or any of your dependents as a business expense, as long as you have set up previously a medical reimbursement plan. So if you haven't set up a medical reimbursement plan, you can't deduct them. Now, to set it up, you need to have an employee, but that employee can be yourself, because if you're a C corporation, you hire yourself. Or if you want to hire your spouse, if you have a spouse to work for you, you can hire your children, but that's not quite as good as hiring yourself. But there's lots of ways to do it. So if you have a lot of medical expense, especially if you're paying a lot for your health insurance, which many of us do, then you want to set up a medical reimbursement plan. You'll need to talk to someone. They have to set it up. You can't do it yourself. There has to be someone who's like a trustee. I think we charge about $1,000 to do it. But that way you can deduct all your medical bills. If you have any further questions on this, then you'll want to contact Marty Wapner in our office. He does more of these medical reimbursement plans than anybody in the United States of America, except maybe for one person who does a lot of farmers. So he's the deduction expert on that one. Okay, and the last subject I'm going to cover now is the most important one.
Are you going?
Oh, did you have something pressing?
Sorry, no. I guess you have all the rest of the slides.
Yes.
I do like to joke in seminars that if people haven't heard about this deduction, it is new in that it's only 100 years old. And it was like you said, it was set up for farmers over 100 years ago. This has been around forever, and nobody knows about it. That's why somebody at our firm does the second most of them in the entire country. And so it is fantastic if you have very high expenses for insurance or very high medical bills, or even moderately high of either of those things. So
yeah, if your insurance, if your health insurance and your well, whatever it is, your health insurance and all your doctor bills, and I'm talking about everything, including vitamins, anything prescribed by a doctor, your glasses, your dental. I mean, if you only had let's say you only had $6,000, okay, but if you can deduct that and you're only in the 40% bracket, you're going to get back $2,400. That's $200 a month you just saved on your taxes, and you only have to pay to set it up one time. So it's up to you. But if you have any questions, like we say, Marty does them. I used to do them, but now Marty's in charge of that department. Thank God. Okay, the last question we're going to talk about is saving money for your future. And yes, Maryland Saves is a wonderful idea, but a lot of you don't have an employee, and a lot of you don't have an employee that you pay with a retirement plan, and you don't have an employee that you pay through a payroll plan. This is something you can do on your own, and it's fantastic. It's called a solo 401k. It was invented in the year 2001 because what happened was the Congress was appalled to find out that so many people weren't saving for their future. So if you have one of these plans, then and by the way, it only costs $160 a year. You can pay more if you want to get it somewhere else. We don't sell them, by the way. We can send you to the person who does mine and Preston's and people in our office. But other than that, if for $160 a year, you can have a qualified retirement plan. Anything you put into it is fully deductible, comes off the top of your return, sort of like what we used to call the front page. And you're allowed to put in 20% of your net income. And if you want to put in more than that, you can actually add another $22,500. If you're over age 50 like me, yes, I guess I have to be, since Preston runs the company now, and he's 40. So that makes me really old, right? Okay, but in any case, you get an extra $7,500. The most you're allowed to put in per year if you're making a lot of money, and I'm sure you are, you're in Maryland, come on, is $66,000 plus the 75. So let's take an example. Somebody brings in $150,000 from real estate, and they go to get their taxes done. They take at least $50,000 in business expenses, but they still have $100,000 left to pay taxes on. Do you want to pay tax on $100,000? No. What you can do is you can hide it in your 401k, and you can take it out the next day if you need it for any reason, but we're not going to talk about that just yet. But how much can you put in out of 100? Well, you're always allowed to put in 22,500, and you're always allowed to put in 20%. So 22,000 plus 20% is 20,000. That's 42,500. And if that person happens to be over age 50, like me, I know you can't believe it. Then they could put in $50,000. Now you're going to say, yes, but how do you live without the 50,000? Ooh, we're going to show you. Go on to the next slide, please, Preston. The solo 401k is the only qualified plan that allows you to do all these things. First of all, it's federally protected 100% from lawsuits, creditors, and bankruptcy. What does this mean? This is not like a SEP or an IRA. Those are unqualified plans. In other words, this solo 401k replaces all those old plans. Not only is it 100% protected from creditors, lawsuits, and bankruptcy, but it allows you to put in more money, because with an IRA, you usually can only put in about $7,500 or something. You're allowed to borrow from it at any time for any reason whatsoever. So if you need to borrow from it to pay your taxes, God forbid, or if you need to borrow from it for a good reason, which I'm going to show you in a minute, you may do so. And depending on the use of the money that you're going to borrow, you can pay it back over 5 to 15 years. If you're borrowing the money out to buy your own home, you can pay it back over 15 years. There's no penalty, no tax, no age limitation. You can have a solo 401k if you're 10 years old or 110, and you have until October 15th of the following year. I just gave Mark my money for my 401k around October 1st. Now we're going to go to the last slide, which really shows you the benefit. Let's say that you have a client and you've shown them a home and they need about $10,000 more to come up with the down payment, okay? So normally what happens is a lot of people, they'll walk into their bank where they have their normal unqualified SEP or their unqualified IRA. They withdraw the $10,000. Well, what happens when you take money out of a SEP or an IRA? It's immediately taxable. So immediately you're going to owe, it's probably somewhere around $2,400 federal tax. You're going to owe 8% Maryland, that's $800. And there's a 10% penalty if you're under 59.5. So out of that $10,000, they immediately owe approximately $4,200. So what's left? Only $5,800. You're going to lose the commission. They're going to lose the house. This can't happen. So what we would do is we would tell your client to roll the money from where? From their unqualified account into their new solo 401k. It takes a couple days. Once it's there, now they borrow out the $10,000 that they desperately need. They don't pay any tax. They don't pay any penalty, state or federal. Now they do have a loan from themselves to themselves, so they have to pay back 5% interest per year on the unpaid balance. Okay, but they're paying the interest to themselves, so their 401k continues to grow, and they have the entire $10,000 to invest in their new home or investment property. I've done this myself. When Preston's younger sister went off to law school, I borrowed $35,000 from my 401k and bought a little townhouse up in Baltimore for her. And I paid $135,000 for the townhouse. 3.5 years later, when she graduated law school and passed the bar the first time, I sold it for $210,000. So not only did I make a nice profit, and she sort of really lived for free in the house, guess what? I had the profit and I paid back my 401k. So if you don't have a 401k, you need to get one. Okay. And if you have a 401k, you can also set it up if you have employees also, and it can work with this new Maryland Saves also. Okay.
Yeah, absolutely.
I did it. I think I did it.
I think we did. Yeah. 3 minutes to go. So we've got 3 minutes for questions. Let's see here. What if your vehicle is wrapped with advertising? Okay. This is, folks, go ahead. Oh, what's that? Yeah, you basically the cost of the wrap, you can, which wraps are actually quite expensive. I know they're a few $1,000s, but the cost of the wrap would be advertising. The vehicle would not be advertising. Basically, at your business miles on the vehicle we use to ascertain, the percentage of business use, and then we write off the vehicle, but we can't write off 100% of the vehicle in that case. But please put some questions in the Q&A if you have any questions. We do have we're getting close to deadline, so I've got to hard out in a few minutes here.
But I can stay if you have any questions.
I mean, if you haven't realized, we both like to talk, so
we fight over who's going to get which slides.
Precisely. I do want to thank you folks for having us again. We do love speaking for realtors and doing education for realtors, because the real estate community is, you folks are 85% of our clientele and have been very good to us over the years.
Oh, love real estate. They're not printing any more land. Real estate is the place to be.
Business expense.
But real estate doing is really hard. Taxes are fun and easy. That's why I stopped doing real estate, started doing taxes.
Okay, so I've got a question that says, I always get confused. What's the best home office write-offs to use as a business expense versus itemization? So you want to write off as much as you can as a business expense first, and then the remainder of your mortgage interest or your state taxes, then that flows over and becomes a itemized deduction. The itemized deduction saves you on 2 taxes, whereas the home office portion saves you on all 4 taxes that we mentioned before. So I hope that answers your question.
4 is better than 2.
Yes, exactly.
You want to say 4 taxes.
Well, Linda, you answered a question in writing, but let's go ahead and repeat it for anyone who's just listening in here today. And the question was, if you're currently on Social Security, if you're receiving Social Security income, does the 15.3 self-employment tax still apply? And your answer was?
Absolutely, yes. You will pay Social Security tax for the rest of your life, no matter what. We have clients in their 80s and 90s that are still doing real estate. A lot of them moved to Florida or South Carolina, but they still pay Social Security tax, even though they're getting $3,000 or $4,000 a month from the Social Security Administration.
Yeah, that's a really good
Thank
question.
you.
That's a very good question. Yes. I'm sorry for the answer, though.
Yeah, answer's not fun, but that's an excellent question. I haven't actually seen that question before.
But you do get to deduct half of your Social Security taxes if you have a good tax accountant. There's a place to do it. Yeah. Yeah, we pay over $31,000 every year for the program that we use to prepare taxes for our realtors.
I would, in all honesty, I wish it was 30 grand. Our software is over 50 grand these days.
Oh, now it's gone up. Okay.
Yeah.
So
Oh yeah.
when I was writing the checks, it was 30. Okay, so we pay $50,000 a year. So obviously our program does a better the job than TurboTax, although we call it Turbo Trash. Sorry. But in any case, make sure that whoever is doing your taxes is paying at least $50,000 for the program to help you prepare the proper tax return. So make sure your return is about that thick, because if it's only that thick, they're missing forms, and for each form that's missing, guess what? You're losing money. Ooh.
Yeah, that's true. That's true.
Realtors, there's 10 important forms you need for every realtor. And if you're missing any one of those 10, that could be a tax. You're losing up $1,000, $2,000, $3,000 just by not having that one form. And since we only charge you $50 or $100 for that one form, it's a really good investment. Plus what you pay us is deductible, or what you pay your accountant, because we're doing fine on clients. We just want to be there to help you. But I'll always answer questions for you, because I'm not as busy as Preston.
You see our website right here. We're gonna I've got to send over a package to you folks to distribute if anybody wants to we can send you over the slide package, but we have a package specifically for realtors to track their expenses. And you don't need to be our client to use it. You fill it out and bring it to your accountant. They'll love you, even though it says our name on it.
Yes. Oh, it's a checklist for your home office. There's a checklist for your car. If you have an investment property or rental property, checklist for your personal deductions. I'm forgetting, but there's a whole bunch of checklists. And if you want to fill them in or check them off, it'll save you a lot of money, and your accountant will be thrilled.
All right. Well, I don't see any open questions. Lisa, you have anything else?
I was just going to ask one. I mean, you guys see a whole lot of returns from real estate professionals. What do you think is the one most overlooked deduction?
The 401k plan. Nobody puts away money for their retirement. And if you're our client and you don't put money in your retirement plan at least every other year, we will fire you. But besides that, there's two other most overlooked deductions. The second most overlooked, I would say, is the medical reimbursement plan. It's been around it's been around since 1955. So anybody who's not using a medical reimbursement plan, who has quite a bit of medical, they will fire your accountant because they're idiots. And the third most overlooked deduction is your office and home. For sure, those three: 401k, medical reimbursement plan, and home office. Those are the three that I get to cover because I'm the one with the most experience, and those are the ones that are always missing on other accountants' tax returns. Preston, what do you see that's overlooked?
I would agree with all of those. I like to start with the home office because it's not that it's the most overlooked, it's that it pertains to 99% of our realtor clients.
But 100% of them need retirement plans. And women tell me, oh no, I don't need a retirement plan. My husband has a 401k at work. Yes, well, you might not be married to that husband. I've been divorced many times. No, you have your own retirement account.
The only reason I don't stress it for realtors is I know realtors can be very bad at saving for retirement,
Not
but
if you
they can
know
be
it.
very good at locking down rental properties. And if you're building your portfolio of rental properties, then I let them off the hook for not having the.
But if they put the money into the 401k, then they can take it out of borrow it from the 401k to buy the rental property. That's what
I know. There's
We
a
did it.
discussion to be had either way, but
we did it. We bought a house. I bought a house for Preston when he was in college for 165. We sold it for 300 or something.
yep, over
Yeah.
300. Yeah.
You lived there 5
Oh
years.
no, the office I'm sitting in right now, I had to take a loan from my 401k to get this, and now I've got plenty of equity in it. You know, it's not the best place to go for money, but in a pinch, it's a great break glass in case of emergency.
But it's the way you can deduct. That way you deduct the down payment. Otherwise, you can't deduct the down payment. If you've deducted it by putting it in your 401k, then when you take it out, it's not taxable. And now you put it into the retirement, the rental property. And it's like win situation.
Except one thing, you know, you got to pay it back with post-tax money.
Yes, that's okay. It's only 5%.
Lisa, see what you've gotten in the middle of?
I try not to. I try
Yeah.
not to get into those mother-son debates.
Lisa and Kelly and Chris, thank you so much for sharing your time with us. And sorry if we talked too fast, but we only had 45 minutes to do it all.
Well, no, we want to thank you both. We also want to thank Chris from Maryland Saves. We hope that you all got very, very good information out of this that's going to help improve your bottom line. And I just wanted to end with a line from an advertisement that Morgan Stanley put out. And it says, by the law, you must pay taxes, but there's no law that says you have to leave a tip. We want to make sure that you are not leaving extra money on the table. And that's why we put this on for you today. We hope that you found it beneficial. And we really do thank you for joining us on this lovely, lovely afternoon. So Kelly, any parting words before we let folks go?
Nope, just want to reiterate that all the slide decks will be shared with registrants, and we will be sharing this video on our YouTube page at Maryland Realtors. Thank you all.
Fantastic.
Thank you. Bye-bye, everybody. Thanks for staying awake.
Thanks, everyone. Have a good day.
All right. Have a good one.
Lisa and Chris. Bye-bye, honey.